Welcome back to Doc Tickers. This deep dive is laser focused on the Q3 2025 earnings call for Gray Media Inc., GTN, the local media giant.
And our mission today is to really cut through the noise. We're going to synthesize the data and deliver the insights you need, especially around this big tension point.
Right, the disconnect between their surprisingly strong cost control and that, pretty conservative forward guidance.
Yeah, that tension was obvious right away.
Oh, absolutely. The initial print was a huge surprise. It set the stock surging. I think it traded up, as much as 17% intraday?
A full 17%. You saw that immediate enthusiasm for their discipline, but then, it started to cool off.
It did.
So the market saw the operational beat. That part was clear.
Yeah.
But the pullback means there's still skepticism. Investors are asking, is this cost cutting for real? And is that huge 2026 political wave already priced in?
So we need to figure out what drove that big initial pop and why the market still seems a little hesitant.
Exactly.
Okay, let's unpack this, starting with a snapshot of the Q3 results. They delivered a really decisive beat across the board. They reported an adjusted EPS loss of 20 cents.
And that matters because the consensus was for a 33-cent loss. So they beat the street by 13 cents. That's a huge 38% upside on the bottom line.
But the number that really moves the needle for cash flow, adjusted EBITDA, came in at $162 million.
Which is just, it's a massive beat. The street was only modeling around $139 million.
So a 16% beat on EBITDA. And it didn't come from some massive revenue surprise either. Revenue was $749 million?
Sure.
Just hit the high end of their own guidance.
And you have to keep the perspective here. Revenue was still down over 21% year over year.
Right.
That's just the inevitable comparison when you're coming off a quarter that had the Olympics and all that political spending in 2024. So the story for Q3, it wasn't about top line growth.
No, it was about protecting the margin.
And they protected it ferociously. And that brings us to the real engine of the beat, expense discipline.
Okay, so their operating expenses, excluding D&A, which is their day-to-day cash expense, basically, that was $592 million.
And this is the critical detail. That number was $17 million below the low end of their own guidance.
Wow.
That's not a rounding error. That is active, aggressive belt tightening at corporate and across every single one of their local stations.
That's exactly what you want to see in a so-called bridge year, right? When the political money isn't there. But the question is always, is this temporary? Are they just cutting into muscle?
Well, management hit that question head on. They said this basically confirms their prior cost actions are sticking. They pointed out that station-level operating expenses, excluding network fees, were down 2% year over year.
And in this inflationary environment, a 2% drop is huge.
It proves this is proactive, deep cost management, not just, pushing bills into the next quarter. It shows efficiency is becoming part of the culture.
That's a very strong signal. All right, let's shift over to the revenue side, starting with core advertising. Core ad revenue was $355 million, down 3%.
Which sounds a little soft, right? But management offered this really fascinating bit of nuance. They said when you adjust the comps to take out the Olympics and political peaks from last year, the underlying core revenue trend was actually up about 1%.
So there's some underlying stability there that you don't see in the headline number.
Exactly. And that's a key differentiator right now. It suggests the local economies where GTN operates are actually more resilient than some of the national trends might suggest.
So if the overall number is soft, where's that strength coming from? What categories are driving that 1% growth?
The bright spots were clearly non-cyclical, so services, especially legal and financial services. They were up high single to double digits.
And that speaks to their local sales teams, doesn't it?
It speaks volumes. These are stable advertisers who need that local reach. It gives GTN a resilient base that, some of the national media players just don't have.
Okay, let's talk retransmission consent. This is the area that always gives investors the most anxiety. Retrans revenue was $346 million, down 6% year over year.
Right. And management used the phrase that net retrans is flattening out.
We should probably define net retrans.
Good call. So that's the money GTN gets from cable and satellite providers, minus the affiliation fees they have to pay back to networks like ABC or CBS. The pressure from cord cutting is real, so seeing it flatten out is actually a good sign. It suggests they're negotiating higher rates to offset losing subscribers.
But the Q4 guide still implies a slight decline there.
It does, and that's mostly because of the WAMF Atlanta station shifting to independent status. That changes the fee structure. But the key takeaway is the pace of decline is slowing way down, which gives you some predictability.
And predictability is what you want when you're carrying debt. So let's look at the balance sheet, because they made some really big moves there. They did a critical refinancing in July.
A masterful move. It pushed their major debt maturities all the way out to 2033.
So that gives them a ton of breathing room.
A massive amount of runway. It takes near-term default risk completely off the table. They ended the quarter with total leverage at 5.77 times EBITDA.
Now, 5.77x, that can sound high to people who aren't used to media companies. Is that a concern?
It's elevated for sure, but for a company with this kind of visibility on political cash flow, it's manageable, especially because their first reason leverage is much lower at 2.72x.
And that first re-in ratio is what the banks really care about.
That's the one. It shows they have plenty of room to maneuver. And the new acquisitions they announce will actually help. They expect total leverage to drop by about a quarter turn once those deals close.
And for anyone holding the stock, they reaffirmed the 8-cent per share quarterly dividend,
which is a forward yield of nearly 7% at these prices. That dividend is a huge part of the whole investment thesis. It basically acts as a floor for the stock. You get paid to wait for the political spending to come back.
Speaking of which, let's transition into their strategic acceleration, because they're clearly not just sitting around waiting for 2026. They confirmed a really aggressive expansion.
Oh, yeah. Entering 6 new markets, creating 11 new Big Four duopolies.
So a duopoly means owning 2 TV stations in the same market. Why is that so important to their strategy?
It's all about deepening their moat. It creates enormous scale efficiencies. You share news teams, sales staff, engineering, everything. You just maximize your margin. Management is convinced this is the only way to sustain that local news leadership.
And they're not just expanding physically. Their digital transformation is finally getting some scale too, right?
Yeah.
With this first-of-its-kind partnership with Google Cloud and Quickplay.
Yeah, and that's rolling out everywhere starting January 2026. This is more than just a press release. It sounds like a massive tech overhaul.
So they're serious about moving beyond just broadcast.
It signals they want to be a digital-first company, owning that direct relationship with the viewer no matter the platform.
That's a big commitment. Let's talk about their biggest commitment, Assembly Atlanta. The net investment there is around $650 million right now.
A huge project. And the commentary on the call around this was maybe the most bullish part of the entire thing. They don't see this as just an expense. They see it as a major asset to be monetized.
How specifically are they planning to monetize it?
Well, the CEO predicted the studio complex could become their biggest cash-flowing operation within 12 to 24 months.
Bigger than their entire broadcast operation.
That was the implication. And not just from their own productions. They're talking joint ventures, leases to major studios, and even selling off non-core assets like the apartment complexes they built around it. They're turning a fixed asset into a revenue stream.
And we got to look at the operational side. With their Once Atlanta station, it went independent, added something like 25 and a half hours of local news.
Which is a huge lift, and it confirms they're all in on local content being their moat. They even used Assembly Atlanta to host a big upfront event positioning WAF as the local CNN. And they said the early viewing numbers are already showing gains.
Okay, so now we have to address the elephant in the room. The thing that caused the stock to pull back after that initial surge, the forward guidance.
Right.
If Q3 was so strong on costs, why did the Q4 revenue guidance midpoint, around $774 million, come in so far below what the street wanted?
It came down almost entirely to one thing: political advertising. The Q4 political guide is just $7 to $8 million.
Which is nothing.
It's tiny. A typical pre-election Q4 is more like 20 to 30 million, so that was a significant miss on that one line item.
Why such a dramatic drop?
Management said it was due to lower fundraising levels earlier in the cycle, which meant fewer early ad buys in the fall. But they were quick to pivot. They emphasized the positive stabilization in the core business.
And that is important. Core ads are guided flat to up low single digits for Q4. And automotive, which was a huge drag, is now only expected to be down low single digits. That's a real inflection point.
And that leads right into the 2026 setup. where the tone from management just shifted dramatically from cautious to tremendous optimism. The CEO called the 2026 cycle potentially gargantuan.
Boy, gargantuan.
Yeah.
After a Q4 political guide that just missed badly, what data is backing that up, or is that just hype?
It's based on early fundraising momentum. They argue that the political machines have been setting records for off-cycle fundraising, building these huge war chests that are just going to flood the market with ad buys next year. They see the cycle as just structurally bigger than ever.
And this really gets to the core investor disconnect, doesn't it?
Yeah.
You have all these catalysts, but the stock is down over 17% in the last 3 months.
The market is still fixated on cord cutting, retrans pressure, the YouTube TV dispute. They're valuing GTN like a shrinking, leveraged broadcaster and completely discounting the improved cost structure and that massive political catalyst that's just 5 quarters away.
Okay, so let's transition now to our This Is Not Financial Advice segment, purely a thought experiment based on the call. How might someone look at this disconnect?
Well, the thesis is all about asymmetric risk and reward. The market seems to be totally missing the upside here. It's failing to price in that 7% dividend yield combined with what management calls a gargantuan 2026 political wave.
So if the cost structure holds and that political money shows up, the stock is just fundamentally mispriced right now.
Exactly. So the outrageous but plausible trade involves combining a long position with a volatility play.
Okay, break that down.
You'd establish a normal long position in GTN common stock right around $4.70 to capture that 7% yield. Then you combine it with selling out-of-the-money put options that expire in mid-2026.
So you're betting the stock won't crash before the political money really starts to flow, and you're using the premium from that bet to help pay for the stock itself.
Precisely. You sell those puts because their implied volatility is high right now, driven by all those fears we talked about. You pocket that premium. If the political tidal wave comes in like management predicts, the stock should move well above $5.50, maybe $6 before those puts expire, forcing a total reevaluation of the company.
It's an interesting idea. Using the fear priced into the options market to finance a bet on a very predictable cyclical recovery.
You're capitalizing on the market's near-term focus while ignoring a massive known inflection point just over the horizon.
So to wrap up, GTN delivered a surprise Q3 beat. It was driven by exceptional cost control. That was the absolute highlight.
No question. They are aggressively laying the groundwork for growth through M&A, through building scale with duopolies, and through that Google Cloud partnership for digital.
This quarter really confirms they're managing this bridge year well. They're focused on the balance sheet, on operational efficiency, and positioning themselves for what they believe is going to be a record-breaking 2026 political cycle.
And the whole story is shifting.
Yeah.
It's moving from managing decline to preparing for a massive revenue surge.
So here's the final thought for you to consider. Management has signaled their M&A focus is now on smaller, strategic deals that support their new sports networks. They are clearly still in expansion mode.
So given that uncertain regulatory environment they keep mentioning, should investors prioritize management's promise to pay down debt with all that 2026 cash? Or should they cheer for continued expansion of their local news and sports footprint, even if it adds complexity? That's the real tension in the GTN story right now.
We want to thank you for joining us for this deep dive into the Gray Media earnings call. If you want us to cut through the noise on your source material, connect with us. We'll talk to you next time.